Welcome back to Ben's Market Insights. Happy New Year to everyone. It's going to be a year of flux. We've already started seeing that in Trump's actions in Venezuela. But I think that what we really want to do at this juncture is talk about what we think is going to happen in 2026. I'm going to split this program into three segments over the next 3 weeks. We're going to talk about the macro this week. We're going to talk about the micro themes that come out of those macro assumptions next week. And then in 2 weeks' time, we'll discuss our asset allocation and how that sort of comes through from the macro scene. If you're enjoying this content, please subscribe to our YouTube channel. Our podcasts are on Spotify and Apple, and give us a thumbs up. So I think that the key elements to really what I want to say for the macro is really driven by two things. One, it's the re-establishment of US exceptionalism, difficult to say, but the reality is that the US is asserting itself on the world stage. That is also being driven by domestic concerns, which really are around affordability and the midterm elections coming up in November. And as a result of that, I think the Trump administration is driving for a very expansive economy in the first half to get people's attention and generate growth so that they could try and win the midterms. I don't think that's going to succeed. I suspect they'll lose the House come November, but I suspect they'll keep the Senate, and certainly that's not going to stop the administration from its activities, but it'll probably neuter them at the margin. But what it does mean is that we get an economy of two halves, a very expansive, liquidity-driven economy and stock markets and risk assets in the first half, and a slowing down in the economy and potential inflationary pressures going into the second half. So let's kick into all of that and try and understand and unweave what that all implies in terms of markets and in terms of investments. The first thing that I think is worth keeping in mind is that as of January, as of the end of this month, we're going to see at least two further appointments to the Federal Rate Setting Committee. Those are clearly going to be Trump appointees. And by May, when the governor of the Fed is going to be chosen, and that we've already had an episode on that, which potentially is going to be Kevin Hassett, whichever it's going to be, it's very likely that we're going to get some kind of Trump acolyte so that we end up having a 5 to 7 committee that is Trump supporting, and therefore very likely to continue to push for lower rates, potentially 50 basis lower rates for going forward from here. And by the mid-year, we're likely to even see 3% or lower in terms of base rates and Fed rates. That is going to be excessive. I think that that's going to drive the economy to grow too fast. That is going to in itself drive inflation higher. And so that by the mid-year stage and possibly into Q3, we're going to be looking at potentially negative real rates. That is a major driver for risk assets, commodities, gold, and certainly is not conducive to a strong US dollar. So we see weak US dollar continuing into next year. We see strong gold prices continuing into next year, despite a very strong year in 2025. In fact, the strongest since 1972. The conditions are perfect for gold to continue stronger, given inflation kicking into the system and yields going into potentially negative territory. Let's address a little bit what could happen to that inflation number, given a very positive aspect, which is the AI spend is largely beginning to make some inroads into productivity at the industry and economy level. We did see some of that kicking in 25. We reckon another 2.5% productivity gains are likely in 26. That's going to put some lid or dampener on inflationary pressure. It would have been nearer 4% potentially by mid-year, but we're probably going to see it around 3.5% thanks to those productivity gains. One aspect that the Trump administration can control in terms of inflation are energy prices. And now we can start talking about the impact of Venezuela and the greater oil market and implications therein. So clearly we've had a very jittery geopolitical environment already at the beginning of this year. What I think is going on here is that we're creating a sort of a ceiling and a floor to the oil price. I think that that's necessary because the floor is thanks to OPEC and Saudi continuing production. And the reason why we need that's the ceiling, we need to create a ceiling for the oil price is because the inflation impact on energy prices and gasoline in domestic American markets will have a very important impact on the inflation basket. So Trump is very keen to keep a lid on that. On the other hand, US is now third largest producer of oil thanks to its shale production, but shale production has a much higher break-even point, nearer $60. That means that they're going to have to look at ways in which to keep that oil price within a range that is not increasing, i.e. inflationary, but keeping shale producers in business. And that, I think, either implies you get cheaper oil, i.e. produced in places like Venezuela, or continue to threaten the oil market so that the impression of higher prices kick in and you're able to maintain a very tight margin for oil prices going forward. So that serves the two functions that, or outcomes rather, that Trump wants to achieve. And I suspect so we'll see around $60, $65 oil price in Brent terms going forward into 26. The other aspect that I think is very important to keep in mind is that there is an element where, whilst Trump is very supportive of the tariff environment, at the same time, he is quite a pragmatic individual and understands that tariffs do imply, even though he'll never say it in public, do imply higher prices. So I suspect we'll not hear much about tariffs this year until the elections. And so that goes into the background. That also is a dampener to inflationary pressures at this juncture. But I think what is going to be a key to driving that fiscal part of the growth, monetary being the Fed and interest rates, is probably going to be the impact of tax credits that are kicking in the first quarter of this year to the tune of about $150 billion. All of that implies expansive and liquidity-driven fiscal and monetary policies in that first half. So just to summarize that US element, and where US goes, the world follows. We're going to see risk assets being driven higher, technology doing well in that environment, AI spend continuing at pace. And then we're also going to start to see a steepening in the yield curve, because as the Fed can control the short end through reducing the base rate, what's going to happen is that investors are going to be very worried about inflationary pressures, and that's going to drive up the long end of the yield curve, resulting in what's known as a Bear Steepener, i.e. a much steeper yield curve, and that is good for the banking sector, and we'll cover that next week when we talk about micro themes. Very bad for mortgages, because mortgages in the US are priced off 10-year yields, and that's going to probably start rising from current levels of 4.1 nearer 4.5% or so. So let's now look at outside the US and what we could expect to find in terms of other markets. So I think that in terms of Europe have reduced rates to pretty much the floor they can reduce it to. They can't get it much further lower. There's not really much inflationary pressure. There's not a huge amount of growth that's kicking in this year. And so it's a pretty steady as she goes type of marketplace. I suspect that the euro is certainly stronger against the dollar and potentially sterling. We'll come back to that, but weaker versus the yen. When we look at the UK, I'm very concerned about what happens to the UK market. I suspect we are going to get a mistake from the Bank of England. They are probably going to reduce rates again. That's going to be the wrong thing to do, and that's because there's going to be very little growth going on in the economy. That means that tax take is going to be relatively low. Taxing the middle class is probably going to increase this year. That's going to create a major fiscal gap that can only be closed through issuance of bonds and gilts. That has to imply higher rates to attract money into the UK. If they don't do that and they actually lower rates, there's going to be significant pressure on sterling. I suspect sterling and dollar are weak, and probably sterling a little bit stronger than the dollar, but not much, but both significantly weaker against the euro and, more importantly, the yen. Speaking of which, I think Japan is actually in a very good position this year. They're probably the only G7 country that are seeing interest rates moving higher this year, more than likely heading towards 1.5% before 2028, when the governor of the central bank finishes his term. We're at 0.75 and rising. And so I suspect that not only is the impact of rising rates going to attract investors to the Japanese yen, but there's also money being repatriated by Japanese investors back into the country thanks to those higher yields, so they can make their savings both in their own currency but also at a reasonable rate of interest. So expect the yen to remain strong throughout the year, and of course that means Japanese assets as well. And then when we look at China, clearly what we have now been hearing more about is something called the Monroe Doctrine, which is effectively a theory that goes along the lines of superpowers control their own hemispheres and control their own areas of interest, i.e. the US controls South America, whatever else they want to do in that region. Clearly, just witnessing the Venezuela impact is part of that process unfolding. But it also means that precedent has been set, and China can now quite easily walk into Taiwan. Putin can do whatever he wants with. Certainly, it's very unlikely that we're going to see any kind of peace accord signed with Ukraine, because he feels he can now expand his horizons in terms of further territory and whatever else, both within Ukraine and possibly even wider afield. Because if Trump is now talking about taking Greenland, which is part of NATO, then and Denmark's position as part of NATO, then if the US as a core member of NATO is against NATO, then Putin will take his chances, maybe. So I think these are all really important geopolitical issues. They set a more dangerous precedent around the world. And I think that, coming back to the China factor, the only thing that I think will stop China potentially acting on Taiwan this year is their relatively weak economy. The economy has really kind of stalled. They do need some kind of economic stimulus, which they haven't had. And that is probably the thing that's holding them back from doing anything aggressive on Taiwan, because what would likely happen is that there would be sanctions against China if they were to do anything against Taiwan, and that would only exacerbate the problems in the Chinese economy. I would then go on to talk about the global emerging markets. We are going to have a very interesting interview in the next couple of weeks published with top fund manager for global emerging markets. But I think it goes without saying that as a corollary to, or an inverse correlation, if you like, to a weak dollar, global emerging markets have performed well in 25 and are likely to perform again quite well in 26, thanks to two factors. One is that weak dollar, plus the fact that we're going to see commodities who are also inversely correlated to the dollar doing well. So that's a plus for emerging markets. But also, like the developed markets, there's a major concentration in technology within the global emerging market index, and that will benefit global emerging markets as well. So I think, to conclude, one of the things that we are likely to see is that inflation is going to tick higher in the US and the UK, stable in Europe, stable in Japan. We're going to see rates falling excessively in the US, mistakes in the UK, stable in Europe, rising in Japan, and inflation is going to effectively erode returns, so that liquidity and going after risk assets is going to be a major factor in the first half. Second half, as inflation kicks in and we move towards negative real rates, that's another matter, and we really need to think about tactically defending our portfolios at that point. More on that next week. Speak to you soon.